The stock market's been going absolutely crazy lately. S&P 500 hits all-time highs, NASDAQ hits all-time highs, valuations are extended right now. Is the market gonna go up? Is it gonna crash? What's gonna happen with the election? What's going on with Tesla over there? That's a big one right there we gotta talk about. Tom Lee just dropped a really big interview on CNBC. We're gonna break down the interview right now. Then we're gonna dive into my trading account. I just made a couple really big plays that's gonna capitalize on the information that you're gonna learn in this video right here.
I'm curious, Tom, in the intro to this segment, Carl outlined what Goldman is saying this morning with regard to kind of longer term returns for equities and the competition they may face from other asset classes if, as Goldman says, the S&P 500 delivers an annualized nominal total return of 3% during the next 10 years. It could face competition, obviously, from potentially treasury yields, which are at 4%. How are you kind of thinking about just the overall asset allocation in light of some of these potential changes in just the overall dynamics of the market?
I haven't seen the Goldman report, and I'm sure it's thoroughly explained, but to me, a 3% nominal return for the S&P, which is basically inflation, tells me that the PE multiple in their model must be contracting because S&P earnings should be inflation plus GDP growth. Let's say that's 6 plus buybacks, which would be 8. And then if there's any multiple expansion, you should add to it. So I think that they're talking about a derating of the stock market. I'm a little skeptical of that because last week I was at a very large advisors conference and I polled the audience. It was close to 400 people in the audience. And I asked, how many of your clients are over allocated to stocks? And I saw one hand. And then how many feel under allocated to equities? Because as you know, a lot of stats show that there's no cash on the sidelines or whatever. I would say close to 80% of the audience raise their hand saying that their clients have been avoiding stocks for the last 2 years and feel under allocated. So to me, that points to stocks having better than expected returns over the next decade because they have to allocate. But, Goldman's, it's 10-year view, so they could be right.
So there's this thing called the lost decade where the stock market could pretty much do nothing for the next 10 years. And the reason why the stock market could pretty much do nothing for the next 10 years is because valuations in the stock market are a little bit lofty right now. But for me personally, I disagree with that report that we're going to get 3% returns for the next 10 years. I think it's going to be a lot more than that. And the reason why is because right now, I feel like we're in a generational shift. It's like the Industrial Revolution right now, but for technology. So that's why the investment that I'm going to show you I made in a little bit is absolutely crucial to take a look at. So make sure you stick around till the end of the video to see that.
But it also fits with your view from a few weeks ago about margin debt, does it not?
Yes, that's right. Yeah, in fact, the audience response is very congruent to what we're seeing, which is there's been a de-risking just in the last 4 months in the face of a market that's been relentlessly rising. I think there's been a lot of macro skepticism, and it's triggered a lot of fears. I mean, partially, I've been fooled by that because I thought markets would stall, but they've been very strong. And to me, the market is the signal.
So just think about it like this. All these professional money managers for the last 2 years, they were under allocated to the stock market. Look at what Triple Q did in the last 2 years right here. It made a massive move right here. So in October 14th of 2022, Triple Q was $260 per share. Right now we're trading at almost $500 per share. That was almost a double of your money in the last 2 years. Those financial advisors, those experts, they were sitting on their hands, they were sitting in cash. Me personally, this dip that was happening right here, I was buying the crap out of it. I was selling puts, I was buying calls. I made millions of dollars off of this dip right here. And this is why it's important to really understand what you're doing in a stock market. All these advisors, they were too scared to invest in the stock market because now it's like the psychology of money will come into play because guess what? As these clients start to realize that they're underperforming the stock market so bad, they're going to put pressure on their advisors to go put their money into the stock market. And they're pretty much going to go do that at the exact wrong time. Right now, I do feel like valuations are a little bit stretched, but once more money starts to come in off the sidelines, that money is going to push the stock market up even higher and become even more expensive. So this is where it comes back to the saying from Warren Buffett, be fearful when others are greedy and be greedy when others are fearful.
What S&P revenue has done in the face of declining inflation, and your general point is that real revenue has accelerated, and that kind of explains why equities have been so resilient.
That's right, Carl. As you know, many investors and pundits thought as inflation fell, and it's been cut in half in the last 2 years, that would cause revenue growth not only to hit a wall, but that earnings would stall. But instead, S&P revenue growth is going to be over 5% this quarter. And on a real basis, that's over plus 2%. And that's the strongest. It's really one of the strongest numbers in more than 2 years. And so it is a really high quality earnings season so far. And, close to 80%, or actually more than 80% are beating earnings so far. So it's a good beat season, but it's early.
So what I care about the most is what is the guidance going forward? What are these companies saying that they're going to report next quarter, next year, and the year after that? The guidance is the number one thing. So for UPS right here, they just reported third quarter earnings. So the revenue right here, it was expected to be $22.14 billion. That was estimated. And they actually reported $22.2 billion. So that showed a beat of 0.27%. And then the earnings per share was expected to be $1.63, that's estimated, but they actually reported $1.76, so that was roughly an 8% beat. So a super important aspect of earnings is what is actual earnings versus estimated earnings. So estimated is literally just what analysts think that the earnings are going to be. I'm not going to lie, analysts are usually pretty good. They're usually within the ballpark of what earnings are usually going to be. But just because you beat earnings, that doesn't necessarily mean it's a good thing. I mean, you can see right here, UPS reported $1.76 earnings for Q3 of 2024. But what if earnings 1 year ago were $5 per share? You could say, dang, it went from $5 a share all the way to $1.76 per share. That's pretty bad. You would expect the stock price to go way down in that time period if that's what actually happened. But if you look at it right here and just think about it like the typical person would, they're going to say, oh yeah, UPS beat earnings by 8%. It's great. But like I just said, if it was $5 a share last year and it's $1.76 right now, that's not really a good thing. Earnings are way down.
Tom, how much would you ascribe the recent momentum to aspects of the election as that draws nearer, just over 2 weeks away?
I think that's been a dynamic. I mean, I've been fooled by seasonality because I figured from September to Election Day, markets would be very tentative because this is an extremely close race. I mean, this is a coin toss, according to Nate Silver. But something that Stan Druckenmiller said last week might explain a lot, that markets are betting that Republicans could take the Senate, and that actually could ignite animal spirits. So there may be underlying momentum that the Republicans take parts of Congress, and that's why markets are bullish.
So if you take a look at these two bar charts right here, this is the average annualized returns of the S&P 500 from 1950 to 2023. So historically speaking, the stock market does the best when it's a Democratic president with split Congress. The second best scenario is when there's a Democratic president where it's a Republican Congress. And the third best scenario is when we have a Republican president with split Congress again. So I think that scenario 1, 2, and 3 are the most likely scenarios to happen. So I do think that is good for the stock market. And I do think the election is definitely overblown. I think that the market's going to be okay no matter what happens. Now, if we go down here and look at the chart right here, so this blue line right here is for Biden. He had a 36% return. Trump right here is red. He had a 67% return. Obama right here had a 181% return, but keep in mind for Obama, he did 2 terms, and also look at when he took over. He took over right after 2008, so he was starting from this super low base right here on this chart, and that's why the stock market ran up so much. The earnings growth was still growing in this time period right here of the S&P 500, but it did this overreaction right here, and right here was a very good time to enter into the stock market. Remember, like I always say, the best days in the stock market are often after the worst days. Really bad days in a market happen right here, but really good days in a market happen right here.
Well, I think that headline CPI could definitely get affected because oil moves dynamically, and it has an almost immediate effect on headline CPI. And we know transport costs have also spiked recently. Part of it's seasonal, but that affects headline. I think the market's going to be somewhat skeptical that could trigger a sustained reigniting of inflation, but I think the economic data is going to be a little confusing the next couple of months because, the Boeing strike itself is going to affect the jobs report. But I think ultimately the Fed is still on a path towards getting back to neutral. I think that should be the focus, and that means, stocks which have been strong are really still a buy the dip market.
I definitely agree with Tom on this one. I think there's so many reasons that inflation is going to keep going down. And honestly, when we get these inflation reports, the data is so laggy in them that really inflation is probably a lot lower than what it's really being reported at. And there's like this silent layoff that's happening right now with a bunch of different companies where as people retire, as people quit their jobs, they're just not backfilling those positions. And maybe AI is replacing some of these people's jobs. And guess what? If AI is saving the company's money, they're going to go with that. They're not going to go hire people. Okay, so this is the $832,000 trading account. 2-year return on this account, almost 200%, absolutely dominating the stock market. And the main reason why I'm dominating the stock market so bad is because of the way that I do stock options. I just dropped a course link below. Check it out. It's cheaper than a date with your wife or a night out with your friends to learn exactly how I do this stuff. So link below if you want to check it out. So here's some of the plays that I have open in my Charles Schwab trading account. So keep in mind, I have a couple different brokers. This is just the one broker that I show you guys. So I sold some puts on Google right here. I'm pretty much flat on that trade. IWM, I sold some puts. I'm up a couple bucks on that one. Microsoft, I sold some puts. I'm up about 2,400 bucks on that one. Triple Q, I have some puts I sold here, up 35. Some Apple ones, 4,500. I mean, you could just go through the list right here. You could pause the screen or you could go back and you could see all the plays that I have open right here. These are puts that I sold. Now, if you look right here, VOO, I now have 520 shares of VOO. So basically what I do is when I sell the puts, I take the premium that I receive and I go buy more shares of VOO and Triple Q. So VOO, 520 shares. I'm up $67,000 on that play right there. Triple Q, I have 912 shares. I'm up 138,000 bucks on that play right there. Tesla right here, I have 500 shares. My cost basis is 149 bucks. And right now it's trading at 269. So I'm up a little bit over $59,000 on the Tesla play that I made right there. I did sell some calls on Tesla. I'm down a little bit on these ones here, and I'm down a little bit on these ones right here. And then down here on the bottom, I sold some puts on Tesla. I'm up $23,000 on those puts that I sold on Tesla. I sold them for $30,000. I could buy them back for $6,900. So I'm up $23,000 on that play right there. And you can see down here, right here on the bottom, I'm up $270,000 of unrealized capital gains on all the plays that I have open in this Charles Schwab account right now. So keep in mind, nobody wins every single trade. Some plays I'll make money on, some plays I will lose money on, but literally 95% of the plays that I make, especially when I sell options, I make money on. If you want to learn how I do this from A to Z, start to finish, check the link below for my course. But if you don't want to dive into the course right now, click this video right here. This is the basis of how I trade stock options. So I'll see you in that video right there.